Matt, how are you reading the recent rally in gold? I think this is so fascinating because we've seen gold rising for 7 straight weeks now. It's just hit a fresh record high. But rather than a celebration, shouldn't this be a warning for investors? What is the rally in gold telling us about the pace of the global economic recovery?
Well, Dan, I think it's telling us a couple of things. First of all, it's telling us that people obviously, or investors obviously, need broader levels of diversification than just owning government bonds or just the US dollar. It also reflects the trend in the US dollar, and the US dollar is coming off. But to me, really, the key message here is that investors are actually wanting to buy an asset which actually produces no income. It costs you to store it and insure it. So gold's almost not an asset, it's more of a liability. But having said that, investors are clearly looking for broader diversification. I think in the end, they're still not convinced about the recovery. They can see gigantic fiscal cliffs, very high valuations, and they see corporate America, which has probably got more headwinds in front of it than tailwinds, because they haven't even dealt with their over-leveraged balance sheets yet. So investors are quite clearly starting to scrutinise the 40% plus market bounce we've had since the March lows, and they're pretty worried about policy withdrawal and rising case numbers. So they need diversification, and they're asking themselves, how can I get it?
Particularly when you look at data out of the US now, which seems to suggest, at least according to analysts that we spoke to last week, that the recovery might be stalling in some way. Just look at initial claims, stateside, for example, which also appear to be levelling off. With that in mind, as we monitor the GOP discussions around the next round of stimulus in the United States, is the economic recovery perhaps at risk if those lawmakers aren't able to deliver what they promise?
Well, in the end, I find it very hard to envisage a US economy or a global economy getting back to normal until we virtually have a vaccine. And the issue I have now with markets and for policymakers is that everyone's having this large debate about the size of the deficit. To me, they need to focus more on the duration of the stimulus, because markets were initially thinking, when the economy went down very hard in the March quarter, they thought, okay, we need to build a bridge between the March quarter and the September quarter. That will be a perfect handover from the stimulus to the labour market, because those who were furloughed will be rehired, and hence the game goes on. But what's very clear is the economic dislocation from COVID, being the biggest supply shock in history, is far longer lasting. And so Congress doesn't need to be debating, the next bill for the September quarter or 2 or 3 months. They almost need to be thinking about the next 12 months. What is required? How are we going to stop the spread of the virus, keep the economy opening? So the adoptions of masks, are very easy solutions there. Doesn't rid the virus, but it does stop its spread. But the stimulus is all important here, and so we need a 12-month plan, not a 2-month plan, which is each one of these stimulus payments has delivered. So I think policymakers have got their eye on the wrong target, which is getting the deficit down. I think deficits are going to be large. They're going to be and very protracted until this vaccine arrives, and it may never arrive. We have to keep that risk in mind too, because the vaccines that we've seen so far have been fairly weak, and it typically takes 4 or 5 years for a vaccine to become effective and available. So, 2 or 3 month plans for fiscal policy probably isn't going to quite cover that.
Yeah, it's really interesting, isn't it, Matthew? And some even asking, look, can you even have a global economic recovery without that vaccine? Look, that's the topic of our next conversation. We'll have to leave it there. But thanks for joining us, Matthew. That's Matthew Sherwood there from Perpetual Investments.